Have you ever watched a stock skyrocket or a market sector explode higher, knowing you had considered buying just weeks earlier but didn't pull the trigger? That sinking feeling in your stomach isn't just disappointment. It's the realization that you saw the signs but couldn't interpret them correctly. What if I told you that the greatest traders in history weren't fortune tellers or mathematical geniuses, but simply master observers who learned to see what others missed? The truth about explosive market trends might shock you. They don't announce themselves with flashing lights or blaring sirens. Instead, they whisper their intentions through subtle market behaviors that most traders are too distracted to notice. Has this ever happened to you? You watch CNBC, read all the financial blogs, follow the hottest trading gurus, yet somehow the big moves still seem to happen when you're looking the other way. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. That's because market trends don't begin with dramatic announcements. They start with whispers, quiet, persistent signals that most overlook in their search for complexity. While everyone else chases complicated indicators and sophisticated algorithms, the disciplined market observer sees the obvious hiding in plain sight. The greatest wealth in trading history wasn't built on prediction, it was built on recognition. Stay with me until the end, because what separates amateur traders from market masters isn't their intelligence or even their system. It's their ability to observe market reactions rather than just market actions. Think about it. When a stock gets hammered with bad news but refuses to make new lows, that's not coincidence. That's accumulation. When a market takes a serious hit but bounces back with quiet strength, that's not random. That's resilience, signaling a potential uptrend. The market communicates through behavior patterns, speaking a language most traders never learn to decode. While they focus on what the market does, they miss how it reacts, and that reaction contains all the information you need to spot explosive trends before they become obvious to everyone else. What you're about to discover might surprise you because it contradicts much of what trading experts teach about complex systems and indicators. I've spent years studying the subtle language of market behavior, watching how prices move in response to various stimuli. The patterns are always there for those patient enough to observe. When a stock declines on negative news, but then stabilizes rather than continuing lower, something important is happening beneath the surface. Smart money is quietly accumulating positions, while the public focuses on headlines. This recognition, this ability to see what others miss, isn't some mystical talent. It's a skill that can be developed through disciplined observation and emotional control. And as we explore this hidden language of market behavior together, you'll begin to notice these signals everywhere, whispering their secrets about which trends are ready to explode while others remain trapped in noise and confusion. If you want to see more market insights like this, hit that subscribe button and join our community of disciplined traders who see what others miss. The real transformation in your trading journey begins when you realize a profound truth that most will never accept. Your intelligence isn't what holds you back, it's your emotions. I've watched brilliant mathematicians and sophisticated analysts repeatedly fail in markets, while seemingly ordinary observers amass fortunes. The hidden revelation behind this paradox isn't that intelligence doesn't matter. It's that emotional discipline matters infinitely more. Consider this: markets aren't mathematical equations to be solved. They're psychological battlegrounds reflecting human behavior patterns. When fear grips the public consciousness, they sell precisely when they should be buying. When greed consumes them, they buy exactly when they should be stepping back. This predictable emotional cycle creates the very trends that could make you wealthy, if only you can stand apart from the crowd's mindset. The most powerful market truth I've discovered in my journey isn't found in complex charting patterns or algorithm-driven strategies. It lies in understanding market refusals, those decisive moments when the market simply refuses to do what conventional wisdom says it should do. This is where the real impact of disciplined observation becomes clear. Imagine a stock getting hammered by terrible earnings. Every analyst predicts further decline. The financial media piles on with negative coverage. By all accounts, this stock should collapse, yet something curious happens. It dips briefly, then stabilizes. It refuses to make new lows despite the onslaught of bad news. This isn't random behavior. It's a powerful signal that smart money is quietly accumulating while the public focuses on the negative narrative. The same principle applies in reverse. When a stock receives glowing coverage, beats earnings expectations, and yet refuses to make new highs, that's distribution. The smart money is quietly exiting, while retail traders are still celebrating the good news. These refusals represent the market revealing its true intentions long before the trend becomes obvious to everyone else. But here's the crucial part most traders miss. These signals appear well before major moves, sometimes weeks or months in advance. The emotional trader, constantly reacting to daily noise, never develops the patience to observe these subtle but powerful messages. They're too busy chasing the next hot tip or worrying about minute-by-minute fluctuations to see the bigger picture forming before their eyes. Your trading decisions must transcend emotional reactions and embrace patient observation. When you learn to spot these market refusals, these moments when price action contradicts conventional expectations, you've found the first footprints of smart money. Following these footprints is how fortunes are built in markets. Now, I want to go even deeper into this topic by exploring how price action speaks a language far more truthful than any news headline or analyst opinion could ever be. The market communicates its intentions through behavior, not announcements. And learning to interpret this behavior is the key that unlocks everything else. Write in the comments, I see the refusals now, if you've experienced watching a stock do exactly the opposite of what conventional wisdom predicted it would do. When you strip away all the noise, the breaking news alerts, the expert opinions, the economic forecasts, what remains is the only market truth that matters: price action. This revelation transformed my entire trading journey. I spent years consuming financial media, reading analyst reports and following gurus, only to discover that these voices were often drowning out the market's authentic message, written plainly in the movement of price itself. The authentic language of the market isn't spoken through headlines or quarterly reports. It's expressed through patterns of behavior that create unmistakable footprints for those with eyes to see them. Every significant market move begins the same way: a series of small but persistent higher lows in uptrends or lower highs in downtrends. These subtle shifts aren't random. They're evidence of pressure building beneath the surface, like tectonic plates slowly shifting before an earthquake. Behind the scenes, what appears as mundane price action to the casual observer actually reveals the precise mindset of the market's most sophisticated participants. When you see a stock making slightly higher lows after each pullback, you're watching smart money quietly accumulating positions. They're not announcing their intentions, they're showing them through their actions. The rhythm of these movements tells you everything you need to know about their conviction and time frame. This is where the art of market observation transcends technical analysis. It's not just about identifying patterns, it's about feeling the market's unique rhythm. Experienced traders develop this sense through thousands of hours of intense observation. They notice when a stock advances, pulls back slightly, then advances again, each retreat becoming shallower than the last. This isn't coincidence. It's the fingerprint of deliberate accumulation by those who move markets. The beautiful simplicity of this approach is that you don't need to know why it's happening. You don't need to understand the fundamental catalyst or have inside information. You only need to recognize the behavioral shift and align yourself accordingly. The market will reveal its intentions long before the reasons become obvious to everyone else. I remember watching a forgotten tech stock for months as it formed this exact pattern. Each week it would advance modestly, pull back less than the previous retreat, then push slightly higher. No major news, no analyst upgrades, nothing to explain the behavior, just this persistent rhythm of higher lows. 6 months later, the stock had tripled when a major acquisition was announced. The market had been telling us this story all along, patiently whispering its intentions while most traders weren't listening. This deeper awareness of market rhythm becomes your competitive edge, your ability to sense accumulation or distribution before major price movements occur. It's about tuning your perception to detect the subtle heartbeat of market behavior rather than being distracted by the constant noise of financial media. The decisions that shape successful trading careers aren't made in moments of excitement, but in periods of quiet observation and disciplined patience. Now let me share how this patience, this ability to wait for the perfect alignment between your observations and market behavior, represents the true secret to capturing explosive trends. Type "rhythm detected" in the comments if you've ever noticed a stock making consistently higher lows before a major breakout and realized later you were watching smart money at work. The greatest paradox in trading, and perhaps the most profound breakthrough in your market journey, is discovering that the real money isn't made in the buying or selling, it's made in the waiting. This revelation runs counter to everything the trading industry promotes. They sell action, excitement, and constant engagement. Yet the masters of the craft understand that disciplined patience is where true wealth accumulates. Think about this hidden truth. Once you've identified a directional trend through careful observation of price action and market refusals, your primary task isn't to keep trading, it's to hold your position until there are clear signs that the tide has turned. This discipline represents the ultimate test of your emotional resilience and conviction. It's where most traders fail, not because their analysis is wrong, but because their psychology betrays them. The mental battlefield becomes intense during this waiting period. Fear creates powerful resistance within your mind, whispering that you should take profits early before they evaporate. Or perhaps it urges you to hesitate too long, entering a position after the trend is already well established. These voices aren't your authentic trading instincts. They're manifestations of emotional uncertainty that must be overcome through disciplined practice. Subscribe now to continue your journey of discovering the hidden patterns and psychological truths behind explosive market trends. I've experienced this inner conflict countless times in my own trading journey, watching a position grow steadily, feeling the temptation to take quick profits, fighting the urge to add more at exactly the wrong moment. The transformation happens when you realize that conquering these impulses is precisely what separates the amateur from the professional. The market doesn't reward your cleverness, it rewards your ability to sit still when everything inside you wants to move. This patience becomes even more crucial when you understand that the market operates on a completely different timeline than most participants expect. It rewards the patient and methodically punishes the hasty. While the masses chase momentum and headlines, successful traders recognize the subtle clues: failed breakdowns, shallow pullbacks, low volume before major surges that reveal trends developing gradually beneath the surface. By the time a trend becomes obvious to everyone, the smart money has already established positions. The financial media suddenly discovers the story. Social media buzzes with excitement. But for the disciplined observer who spotted those early market refusals and price patterns, this public recognition simply represents confirmation of what they already knew, and possibly the beginning of the end for that particular trend. This patience isn't passive. It's an active, deliberate practice requiring tremendous self-awareness. It means constantly checking your impulses against your trading plan. It means weathering short-term volatility without abandoning your long-term thesis. It means trusting the market's behavior over your emotions or external opinions. Few develop this discipline, which is precisely why the rewards for those who do can be so extraordinary. The mindfulness required to maintain this patient positioning goes beyond trading. It represents a profound life skill. Markets merely provide the perfect arena to develop this rare ability to act decisively when appropriate, but remain perfectly still when necessary. Let's explore how our natural human ego often becomes our biggest obstacle in developing this essential market discipline. Drop "patience pays" in the comments if you've ever sold a position too early out of fear, only to watch it continue climbing without you. One of the most liberating realizations on your market journey is understanding that trading success doesn't come from finding perfect entry points. It comes from recognizing perfect market behavior. This subtle shift in perspective transforms everything. Most traders obsess over exact prices, wondering whether to buy at 42.50 or 42.75, creating elaborate systems to identify the perfect moment to enter. Yet they completely miss the bigger picture of what the market is actually communicating through its behavior. The wisdom of experience teaches that when a stock consistently demonstrates strength by quickly recovering from pullbacks, that behavioral pattern itself is far more valuable than any specific entry price. It's showing you its character, its resilience, and underlying momentum. This isn't about your personal feelings or assumptions. It's about what the market itself is revealing about its strength. The revelation comes when you stop imposing your expectations on the market and instead learn to read what it's already telling you. I remember watching a biotech stock during a market correction. While other stocks in the sector dropped 15 to 20%, this one fell just 5% before stabilizing. When the market began to recover, it led the advance, quickly making new highs while peers were still struggling. That behavior wasn't random. It was a clear message about institutional support and accumulation. Traders fixating on perfect entry points missed the far more valuable signal, the stock's behavioral strength relative to its peers and the broader market. Behind this approach lies a profound truth about market mastery. It requires us to set aside our egos and embrace genuine curiosity about what's actually happening, not what we think should happen. Ego becomes the silent killer of trading accounts, whispering dangerous certainties into our ears precisely when we should be most open to changing conditions. The moment you believe you know what will happen next in the markets, you've already compromised your edge. That false certainty blinds you to new information and makes you resistant to adapting when conditions shift. No. 1. Not legendary investors, not Wall Street institutions, not sophisticated algorithms can predict markets with absolute certainty. The best we can do is interpret the evidence before us and remain flexible enough to adapt when market behavior changes. This mindset represents a complete identity shift for most traders. Rather than seeing ourselves as predictors, we become interpreters, constantly observing, processing new information, and adjusting our understanding as markets evolve. Humility becomes our greatest asset, allowing us to see clearly without the distortion of ego-driven expectations. Flexibility becomes our competitive advantage, enabling quick adaptation when market behavior shifts. The journey toward this awareness often comes through painful lessons. I can't count how many trades I've watched go against me while I stubbornly clung to my original thesis, refusing to acknowledge that market behavior had changed. The breakthrough comes when you realize that being right isn't what matters. What matters is being aligned with what the market is actually doing, regardless of what you thought it would do. This philosophical approach transcends trading and touches on deeper wisdom about how we navigate uncertainty in all aspects of life. Markets simply provide the perfect laboratory to develop this rare capacity for evidence-based interpretation rather than ego-driven prediction. Let's explore how the early stages of major market trends consistently begin with widespread disbelief, and why this psychological pattern creates extraordinary opportunities for the prepared mind. Share ego-checked in the comments if you've ever had the humbling experience of being absolutely certain about a market move, only to watch it do exactly the opposite of what you expected. There's a fascinating psychological pattern that accompanies the birth of every significant market trend, one that creates extraordinary opportunity for those who recognize it. Every great bull or bear market begins amid widespread disbelief, skepticism, and often outright ridicule. This counterintuitive reality reveals something profound about market psychology and the journey toward financial independence. Consider the awakening that happens when you first notice this pattern. The 2009 bull market began with experts predicting further collapse. The crypto revolution started with established financial figures dismissing it entirely. The post-COVID recovery launched while headlines warned of prolonged depression. This consistent pattern of disbelief isn't coincidental. It's essential to how markets function. The public consciousness clings desperately to past patterns, interpreting emerging trends as mere temporary corrections to what they consider normal. The revelation comes when you realize that by the time widespread acceptance finally arrives, when your neighbor starts giving stock tips or the financial media declares a new era, the trend is often already halfway complete. The greatest opportunities don't announce themselves with fanfare. They arrive disguised as impossible scenarios that most reject outright. This creates the perfect environment for disciplined observers to position themselves while valuations remain attractive. Behind the scenes of this disbelief phase lies a powerful emotional dynamic. Most market participants anchor their expectations to recent experience rather than adapting to emerging evidence. They create elaborate narratives, explaining why the new trend can't possibly last, rather than objectively assessing what's actually happening. This collective emotional fog creates the very inefficiencies that make markets exploitable for those with clarity of vision. This brings us to perhaps the most transformative question any trader can learn to ask. What is the market refusing to do? This simple inquiry cuts through complexity and reveals the authentic character of any market environment. When a stock or sector refuses to fall despite negative news, that's not randomness, that's underlying strength. When it refuses to rally despite positive developments, that's not confusion, that's weakness. I've witnessed this principle countless times across different market cycles. During the early stages of major tech advances, certain stocks consistently refused to break down during broader market corrections. They dip briefly, then quickly recover to new highs, refusing to participate in the general weakness. That behavior wasn't accidental. It was institutional accumulation happening right before our eyes, visible to anyone watching with emotional neutrality. This neutrality, this rare ability to observe price movement objectively without fear or excitement clouding judgment, represents the pinnacle of trading psychology. It's not about suppressing emotions, but developing awareness of how they influence perception. The market doesn't care about your hopes or fears. It simply expresses the collective decisions of all participants through price. Learning to see this reality clearly, without emotional distortion, is the journey of a lifetime. This perspective doesn't come naturally. We are hardwired for emotional responses. Fear when prices fall, excitement when they rise, but developing the capacity for neutral observation creates an almost unfair advantage in markets where most participants remain trapped in reactive emotional cycles. Let's explore how this quiet observation reveals something even more subtle, how major trends often begin in periods of apparent boredom and decreasing volatility. Drop disbelief recognized in the comments if you've ever watched experts dismiss a market trend that went on to become a major move, making you question conventional wisdom. One of the most counterintuitive discoveries in my market journey has been realizing that the biggest trends often begin in periods of apparent boredom. This hidden truth contradicts everything the financial media promotes with their constant emphasis on excitement, volatility, and breaking news. Yet the quiet revelation awaiting the patient observer is that before truly explosive moves, markets typically go through phases of decreased volatility and seemingly dull activity. This silence, this peculiar quieting of market noise, isn't random. It's actually a profound signal that smart money is methodically positioning before the trend becomes obvious to everyone else. While retail traders complain about boring markets and seek excitement elsewhere, institutional players are quietly accumulating positions, careful not to create dramatic price movements that would reveal their intentions. The enlightenment comes when you recognize this silence not as the absence of opportunity, but as the prelude to it. I've watched this pattern unfold countless times across different market cycles. A stock trades sideways in a tight range for weeks, sometimes months. Volume gradually decreases. Media coverage dwindles. Retail interest evaporates. Then suddenly volume surges and prices break decisively from that quiet range. By the time everyone notices, the stock is already 20 to 30% higher. The informed traders who recognized the significance of that quiet consolidation were already comfortably positioned when the move began. This awareness illuminates a deeper truth about market perception. Most participants completely misunderstand the relationship between movement and trend. They confuse daily price fluctuations with actual directional trends, a fundamental error that destroys more trading accounts than perhaps any other misconception. The transformation happens when you realize that movement is merely noise, while trend is actual direction. One distracts, the other enriches. Markets fluctuate constantly, creating an endless stream of movements that trigger emotional responses. But authentic trends, the kind that create life-changing opportunities, develop over weeks and months, not hours or days. They form distinct structures, visible only when you step back from the daily noise and observe the bigger picture. This perspective shift requires a completely different mindset from what most trading education promotes. The disciplined observer learns to zoom out, both literally on charts and figuratively in their thinking. They look for the unmistakable architecture of trends, a series of higher highs and higher lows in uptrends, or the opposite pattern in downtrends. These structures don't form randomly. They represent the gradual shift in supply-demand dynamics as larger players establish or unwind positions over time. This ability to distinguish between meaningless movement and significant trend represents a complete paradigm shift in trading consciousness. It's the difference between being constantly whipsawed by market noise and riding major moves with relative ease. The breakthrough comes when you stop reacting to every fluctuation and develop the capacity to identify genuine directional momentum through structural analysis. Behind this awareness lies a profound spiritual truth about markets. They operate on multiple time frames simultaneously, each with its own rhythm and significance. The daily noise that consumes most traders' attention exists within larger weekly patterns, which themselves exist within monthly and yearly cycles. Learning to perceive these nested timeframes creates an almost three-dimensional understanding of market behavior, impossible to achieve when fixated on short-term movements alone. This expanded perception doesn't just improve trading results, it transforms your entire relationship with markets. The anxiety of day-to-day fluctuations diminishes as you connect with longer-term trends. Let's explore why proper capital management becomes the essential foundation, allowing you to participate in these trends with confidence rather than fear. Share "I see structure now" in the comments if you've ever had that moment when you zoomed out on a chart and suddenly recognized a clear trend that was invisible when looking at daily movements. Even with all the market wisdom we've explored, recognizing refusals, reading price action, identifying emerging trends, there remains a foundational principle that supersedes everything else. You must manage your capital as if it's your lifeline, because it is. This revelation often comes at great personal cost for many traders, myself included. The humbling truth is that even when trends seem completely obvious and your analysis feels bulletproof, the market can change direction with stunning speed and ferocity. The profound awakening happens when you realize that proper risk management isn't just a technical requirement. It's the philosophical cornerstone that makes everything else possible. It means never risking your entire journey on a single opportunity, no matter how compelling. The market doesn't reward those who bet everything on one trade. It rewards those who survive long enough to participate in multiple significant trends over time. I've witnessed brilliant analysts with extraordinary insight into market behavior wipe out their accounts because they failed to respect this principle. Their market understanding was impressive, their trend identification flawless, but their risk management was catastrophic. Without capital, no system or insight matters. This sobering reality transforms how you approach every position, creating a mindful awareness that true edge comes not from any single trade, but from the cumulative results of many trades across various market conditions. Capital preservation becomes your sacred responsibility, not to avoid risk, but to ensure you remain in the game long enough for your edge to manifest. This perspective shift creates a completely different relationship with market volatility. Price fluctuations that terrify the undercapitalized trader become merely the normal rhythm of markets for those who position size appropriately and diversify their exposure across different opportunities. The deepest transformation in your market journey comes when you finally understand that the ultimate secret isn't predicting market moves, it's mastering your own psychology. This revelation often arrives after years of searching for the perfect system, the perfect indicator, or the perfect guru, only to discover that the answer was always within. Success requires clarity of thought to see what's actually happening rather than what you hope is happening. It demands patient observation when everything around you screams for action. This mastery requires the courage to act decisively when signals are clear and the restraint to step aside when they're mixed. It means developing the rare capacity to hear the market's whispers before it roars, while everyone else chases the noise of already obvious moves. The market itself is never wrong. It simply expresses the collective decisions of all participants. It's our opinions, biases, and emotions that create the dissonance between expectation and reality. Behind the scenes of every successful trader lies this psychological foundation, not just understanding markets, but understanding themselves. The journey toward this self-awareness often begins with technical study, but inevitably leads to profound personal growth. Markets simply provide the perfect mirror, reflecting our fears, hopes, impulsiveness, and patience with brutal clarity. I remember the turning point in my own development when I stopped fighting the market's messages and started truly listening to them. The mental liberation was extraordinary. No longer needing to be right, no longer attaching my ego to outcomes, simply observing and aligning myself with what was actually happening rather than what I thought should happen. This mindset shift didn't just improve my trading results, it transformed my entire relationship with uncertainty in all aspects of life. The beautiful paradox is that by surrendering the need to control markets, you gain the ability to navigate them with remarkable precision. By accepting that you cannot predict with certainty, you develop the flexibility to adapt to changing conditions. Let's explore how these principles manifest in practical decision-making when confronted with potential explosive trends forming right before your eyes. Type "inner mastery" in the comments if you've realized that your biggest trading challenge isn't understanding markets, it's understanding yourself. As we wrap up this journey into the hidden language of market trends, I hope you've gained something valuable, not just about trading, but about the deeper psychological patterns that drive all markets. This awareness has transformed my own relationship with uncertainty, and I've seen it do the same for countless others who've embraced these principles. If this perspective resonated with you, I'd love for you to join our community of disciplined observers. Hit subscribe so we can continue exploring these market truths together. Each week, we dive into another aspect of market psychology that most traders never discover, building that rare capacity to see what others miss. I'm genuinely curious about your own experiences with these concepts. Drop "Market Whisperer" in the comments if you made it to the end and found yourself nodding along, recognizing patterns you've witnessed in your own trading journey. Your insights often inspire future videos and help fellow traders realize they're not alone in this challenging but rewarding path. If you found value in today's exploration, a simple like helps tremendously in sharing these ideas with others who might benefit from this perspective. It's always meaningful to know these concepts are reaching people who appreciate the deeper truths behind market behavior. There's a video right here that complements what we've discussed today. It explores the specific price patterns that often appear just before explosive trends begin. Click and continue with me over there as we build upon these foundations and develop even greater clarity in spotting opportunities before they become obvious to everyone else. Until next time, remember, the market whispers before it roars.